When this act was introduced or talked about to begin with, they talked about simplification of the tax law, which I think probably for many people it is true that it is a little bit simpler, perhaps a little less complex. But for many others, it got very, very more complicated, especially with regards to the international provisions. So it's interesting to see how that's really going to affect people. You know, the postcard return, I don't think is going to take place, but I think they want to keep the accountants fully employed. Talking about the corporate rate changes, that was really one of the corner pieces of the law. They wanted to make U.S. corporations competitive on a world basis, so they lowered the corporate rate to 21%. Now, the old rate was a graduated rate of up to 35%, and you did get a small business exemption on the first $50,000 or $75,000 of income. So on the first $100,000 of income under the old law, you pay $22,250. Now it's a flat 21%. You would pay her $21,000. And I think there's a lot of good in that it's really tried to hopefully jumpstart the economy and keep a lot of the funds in the U.S. as opposed to overseas. We'll see how that plays out. I actually remember back in the early 80s, I think the tax rate for corporations was at a 46% rate. So it's really gone significantly down over the years. The other thing to mention is if you have a personal service corporation, under the old law, they paid 35% from $1 forward. They had no graduated rate. Now they get a flat rate of 21%. So that's quite an improvement for some people that have personal service corporations, maybe doctors, engineers, accountants, lawyers. That could be a possibility of perhaps putting away some money at a low tax rate. The other thing is that the law is kind of for fiscal year corporations, they'll get a blended rate. So if you have a corporation with a year end of September 30th, 2018, they'll get 9 months of the new rate, if you will, of the 21%, and 3 months at the old rate of potentially up to 35%. Now, I don't think the 35% kicked in until we reached $10 million of taxable income, which probably didn't affect too many of our clients. A lot of them have pass-through entities where it was not taxed at the corporate level, but taxed at the individual level. Dividends received deduction. Excuse me. Basically, they've lowered the exclusion amounts to reflect the lower tax laws, the lower tax rate in effect of 21%. So it kind of gets you back to where you would have been under the old law for the dividends. Alternative minimum tax. And just as a backdrop, that was introduced in the law probably over 50 years ago, before I was in practice, if you were curious. And that was really meant to make sure that both individuals and corporations paid some type of tax and they couldn't shelter all their income. I think many of us in the room who are individuals suffer from the alternative minimum tax living in New York State, which, as Jennifer pointed out, is still here, but not to the extent it was. But for corporations, it's actually repealed for tax years beginning after 12/31/17. If one of the corporations paid the alternative minimum tax in prior years, that is a refundable credit, which they'll get over the next 4 or 5 years at 50% a year for the first, I think, 4 years through 2020. The balance will be refundable in 2021. Just a couple of points. If you got an accrual basis taxpayer, you really want to look at your balance sheet as of 12/31/17 to see if they're catching all the accounts payable, to make sure you're getting all the deductions you're entitled to, because those are potentially 35% dollar savings at the federal level. Whereas if you don't get it in 2017 and it slips to 2018, it costs you 14 percentage points potentially. That's also true for like accounts receivable. While the IRS does not allow an allowance for doubtful accounts to be deductible, you can use the direct write-off method. So if you've got some potentially highly uncollectible accounts, you might want to consider writing those off in 2017 to get the deduction that year. Okay. Modification of net operating loss. This was, I think, interesting change in the law. Before, you could carry it back 2 years and forward 20. Under the new law, well, first of all, the prior losses incurred in prior years still apply. They get carried forward. However, and they get carried back if you had any in 17, you could still carry it back. Going forward for 18, you can no longer carry losses back incurred for years beginning after 12/31/17. They don't want anybody creating losses in closely held corporations to carry back those losses and get 34% or 35% dollars back. And they can only be carried forward then. Just an interesting planning point is they'll be limited in the future to 80% of taxable income. As we're going to talk about in a few minutes, there's been significant depreciation changes. So you want to be sure that maybe you don't bring your income down into a loss situation, maybe to a near break-even situation. But if you can help it with depreciation, you don't want to create a loss needlessly. Limitation on business interest expense. Section 163J has been basically revised, and it reads differently than it did in the past. First of all, it's limited to 30% of adjusted taxable income. And that's basically, you take the net income of the corporation and you have certain add backs. And for years beginning before 1/1/22, you add back the deduction allowable for depreciation, amortization, or depletion. And you also add back, obviously, the interest expense to get the adjusted taxable income. You take 30% of that number, and that's your limit on interest expense at the corporate level. Very important exception is if a corporation has average annual gross receipts of under $25 million in the prior 3 years, that rule doesn't apply. There's no limit on the interest expense deduction. Domestic production activities deduction, which was in the law, allowed certain corporations, either in the processing or manufacturing arena, to deduct up to 9% of that qualified income as a deduction. And that was really put in play to allow for manufacturing companies to get a lower tax rate. With the new law, that has been repealed, and the theory is that with the lower corporate rates already in effect, they no longer really need that deduction anymore. So that's repealed. This is the really complicated part, which affects people in the cross-border arena. And it's called the 965 transition tax. And this tax is really aimed at the large multinational corporations that have parked significant dollars overseas. And they did this by maybe shifting their intellectual property to countries with very little, if no tax. I think Ireland was one of the popular countries. There's a few other countries as well where these large corporations have parked, literally billions of dollars of profits overseas and have paid no tax. So the theory is now this tax, this transition tax, is going to catch these corporations. And basically what it is they look at the accumulated earnings and profits as of two testing dates. One is either 12/31/17 or one is 11/2/17. They look at the earnings and profits of the corporation, which is retained earnings with certain adjustments. They take that number and then they bifurcate it into two classes of assets. One would be like cash, accounts receivable, net accounts receivable, marketable securities. And they tax that at one rate. That's at 15.5% for corporations. And then for the remaining assets you take the retained earnings, or E&P, less those first assets, the cash and near cash assets, the balance gets taxed at 9.05% for corporations. This is expected to generate billions of dollars of tax for 2017 at the corporate level. As an aside, it also affects individual taxpayers that have a controlled foreign corporation, which we have a lot of in our office. Not that it's any exotic scheme, but U.S. citizens, I think we're one of maybe 2 or 3 countries in the world that tax on citizenship. So let's say you've got a person living in Canada who's built up his corporation for the last 30 years, now has a fairly significant amount of retained earnings in the corporation. They too, by virtue of this tax, are now subject to this tax. And we've heard a lot of complaints about it from our cross-border clients, because basically you're taking this corporation they've built so hard over the years and you're making them pay a tax on it. And they're in their country of residence, they're maybe living in Canada, they've got a Canadian corporation, and they're subject to this tax. So it's been a very significant burden on them. They talk about the definitions of a controlled foreign corporation. Basically, it looks at the shareholders and the voting percentages of the corporation. Now, if either the corporations or individuals have foreign tax credits, they can offset that tax, but the balance then is due at the taxpayer's election. They can pay that over an 8-year period with 8% payable in each of the first 5 years. Then it goes to 15, 20, and 25% for the remaining years. That's also true for corporations. One of the planning techniques we're looking at for individuals in this situation is to have them pay substantial dividends out of their foreign corporations, their Canadian companies, to generate enough foreign tax credits to carry it back to their 2017 return, where they could go back and amend the return, claim a refund for the taxes paid in 17, and hopefully eliminate the bleeding going forward. Another new tax is called the GILTI tax. This is the Global Intangible Low-Taxed Income Tax. And basically this is, again, aimed at corporations that have parked maybe their intellectual property overseas. They're basically going to allow certain deduction against that net income, but the net income will be currently taxable. So for a large corporation, if they have any subsidiaries with profits parked overseas or in 2018 and forward, they'll be subject to tax in the U.S. However, the corporations will probably be in pretty good shape because they will get to deduct half of that income. And as long as they're paying tax at the rate of about 11% in the foreign jurisdiction, there'll be no U.S. tax payable on that. That will allow them, in effect, to bring the money back home tax-free. They've already paid the transition tax, though. I don't think I need to go through that. Basically, and this also applies to individuals, they're not in such a good shape because the rules that work differently for individuals. Basically, the era of deferring income and control of foreign corporations is basically over. And they had some CFC rules put into effect, I think it was back in the Kennedy administration originally, to kind of prevent the parking of income overseas. This kind of kills that now going forward. Depreciation changes. These are really significant, and again, they're kind of put in place to really help companies to add investments, add equipment, depreciable property to their businesses, and get an immediate write-off. And there's 2 ways of doing this. One is the Section 179, which has been around for a long time. Basically, this allows you to put assets in service in a current year and elect to depreciate that all in 1 year. So you still capitalize the asset, but you deduct it all in 1 year as depreciation. Under the old rules, you could deduct up to $500,000 per year. Now it's up to $1 million per year. There was a phase out, though, under the old law. So if you added more than $2 million of equipment in a year or qualifying assets, you started to lose the ability to deduct under 179. And it was a dollar-for-dollar reduction in the limitation. So if you had, let's say, $2,100,000 of additions under the old law, you would lose $100,000 of 179 expense. Under the new law, that's been raised to $2.5 million, that threshold, before it starts to phase out. They've also changed the definition of Section 179 to add certain other property. This is for non-residential real property. Roofs, heating and air conditioning equipment will qualify. Fire alarm systems, security systems will all qualify. I think that was really done as a benefit to some of the smaller companies or individuals that had assets additions every year. I think the IRS is getting tired of fighting with something's either capital in nature or is it really a repair. One of the things that they omitted from the law is something called qualified improvement property. Prior to 12/31/17, if somebody had restaurant improvements rather, they could write that off over a 15-year period. They meant to put in the law a category called qualified improvement property, which you could write off over 15 years and potentially claim bonus depreciation on. That never made it to the law. It was an omission, and we'll see if there's a Technical Corrections Act to fix that or not. Another new thing, I guess it's changed, is the cost recovery method. It's called bonus depreciation. Now, it's been around for a while, but it's been greatly enhanced. So now if you put in assets in service after 9/27/17 and through 1/1/23, you can take 100% bonus depreciation in the current year. For some companies, the 179 actually works out better, even though you get to deduct 100% under both if you qualify, because some of the states will accept Section 179 depreciation, but I think almost all of the states decouple or don't allow that bonus depreciation. So you've got to do a separate depreciation schedule for the state. But if you take 179, the states will generally accept that. The bonus depreciation, they will not. And basically the bonus, the 100% phases out down to 80, 60, 40, 20, then 0 over the next 5 years. And this time around, both new and used property qualify for this bonus depreciation. In the past, it had to be new. Now it only has to be acquired or new to the taxpayer, but it can certainly be used equipment. And it must have a depreciable life, these assets, of less than 20 years to qualify for the bonus depreciation. Luxury auto limitations. They finally made some modifications to this. Before, I think if you bought a $16,000 car, anything above that was considered a luxury auto. That law's been around for quite a while, and I'm not sure what you can really buy for a new car for $16,000 today. And I think they finally recognized that limitation. So now for the first year, you can get $10,000, $16,000, $9,000, and $5,760 for years after that. Interesting to note, a quirky thing I consider, is that it assumes no bonus depreciation was claimed. If you claim the bonus depreciation, you get $18,000 the first year, which sounds like a really good deal. You get nothing for the next 4 years. So I think most taxpayers with the luxury autos will continue to claim the regular depreciation and not take the bonus.